So Islamic finance has been a well-studied topic for many Western institutes over the last few decades, and countries who practice Islamic banking has been seen to have some very strong economy. And since we are currently in the month of Ramadan, I feel like this would be a great financial topic to uncover. What's going on, guys? Chris Robinson here. In today's video, we will be going over topics related to Islamic finance. So if this is something that is new to you, or even if this is something that you heard of but you don't have much knowledge of, I suggest that you watch through the full video, take notes, like and subscribe for future videos like this. Without further ado, let's jump right into it. Okay, so Islamic finance is a nearly $3 trillion industry, which is practiced in about 80 different countries. $3 trillion is a lot of money. However, the more surprising part is that it is generating all of this money within this industry from very few markets. And the simple definition of Islamic finance is the compliance of financial activities and investments with Sharia law. So if you're not familiar with Sharia law is known as Islamic law, which is religious law that derives primarily from the Quran and Hadith. And since we're on the topic of Sharia law, let's first examine some of the things which are prohibited related to Islamic finance. So the first thing we'll try to understand is known as RIBA or usury. RIBA is broad. However, the more commonly known English translation would be considered interest, which is in fact prohibited according to Sharia law. The Quran explicitly prohibits riba in many different surahs because it is seen as an exploitative practice that favors the lender over the borrower because of the continuous debt that derives from it. In today's conventional banking and finance, riba is the core funding source for just about all banks and lending companies. Anything from car loans, home loans, personal loans, and even overdraft fees are seen as riba. There is also riba in saving and fixed deposit accounts, and nonetheless, credit cards also hold riba. Okay, so the next thing we'll be discussing is Gharar. The Arabic word Gharar has many different meanings. However, it is more aligned with anything that is risky, deceiving, fraudulent, and the idea of uncertainty. Also, anything that is hazardous that can lead to loss is also known as Gharar. However, Gharar is divided into two parts, Gharar Yasir, which is a light amount of Gharar, and Gharar Fahisha, which is an excessive amount of Gharar. Islamic scholars believe that every contract has some amount of Gharar. However, the amount of it is different from each contract to contract. Things like derivatives and short selling that is common in conventional finance is an example of Gharar, which is in fact prohibited in Islamic finance. Okay, so the next thing that is prohibited in Islamic finance will be related to any businesses that practice haram activities. According to the Sharia, any businesses that perform haram practices or sell haram goods is a business that you will need to avoid. So haram means forbidden or in some cases illegal. For example, selling pork, alcohol, and allowing gambling would be considered haram. So investing or operating a business that involves in these activities will be against the Sharia. And lastly, let's now discuss Maysir. Maysir, or speculation, is the practice of investing your money in hopes for a gain without certainty, which can also result into a loss. And the most common comparison to Maysir would be considered gambling, which we had already mentioned as a haram practice. The Quran explicitly prohibits gambling, and things like derivatives and insurance are also examples of Maysir. Okay, so now that we have discussed most of the prohibitions of Islamic finance, let's now dive into some financial arrangements which would be considered halal or permissible in Islamic banking. A profit and loss sharing partnership is known as Mudarabah, which is the first thing we'll discuss in regards to halal arrangement. Mudarabah is an agreement between partners in which one partner will be the financial provider and the other will be the laborer. Whatever profits that are gained from that agreement is then shared between the partnerships according to the terms of that agreement. The next thing we'll try to understand is Musharakah. Musharakah is a form of joint venture where all parties involved contribute capital and share the profits and loss on a pro-rata basis. The major types of these joint ventures are diminishing partnerships and permanent Musharakah. Diminishing partnerships is a type of venture that is commonly used to acquire property. The bank and investor jointly purchase a property. Subsequently, the bank gradually transfers its portion of equity in the property to the investor in exchange for payments. Permanent musharakah, on the other hand, is a type of joint venture that does not have a specific end date and continues operating as long as the participating parties agree to continue operations. Generally, it is used in financial long-term projects. And lastly, Ijarah, which is translated as leasing. This is leasing, as you may know already, in which a leaser will lease out his property in exchange for payments to a leasee, and by the end of those terms, the leasee will eventually own that property. Now let's talk about some basic investment vehicles within Islamic finance. Keep in mind, there are many prohibited practices as compared to conventional finance. However, within Islamic finance, there are two commonly used investment vehicles, that is equity and fixed income. In terms of equity, Sharia law allows investment in company shares in terms of their common stocks as long as the company does not engage in haram activities. Investment in companies may be in their shares or by direct investment or private equity. Fixed income, on the other hand, could be a little tricky since bonds could involve RIBA. However, sukuk, which means financial certificates, is more commonly known as Sharia compliant bonds. This is a bond that has shared ownership in an asset but does not hold a debt obligation. Okay, and lastly, before I close this video, I do want to discuss some basic insurance vehicles within Islamic finance. Since traditional insurance will be considered haram based on risk management, within Islamic finance, there are some many guidelines that should be followed. And the Sharia allows something known as cooperative insurance. This is when the subscribers contribute to a pool of funds. These funds are then invested into permissible activities. Whenever a claim is submitted, funds from that pool will go towards the incident, and whatever funds that has not been claimed will be distributed among the policy holders. Alright guys, so that's some basic information related to Islamic banking and finance. If you find this video helpful, be sure to smash that like button to show your continued support for this page, and stay tuned for the next video. Peace.